Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Bob. It's fantastic to have you back on the podcast show.
Thanks so much for having me.
Now, before we start our conversation, I do need to timestamp our conversation because a lot is moving around. So we're recording this on Wednesday, 4th of September, just after the JOLTS data. And before the market close. So this is before payrolls. So you may be listening to this after payrolls data has been released. But with that aside, Bob, you've been a big advocate of this idea that we're in a income cycle in this current business cycle rather than a credit cycle. And you think that many people are using the incorrect framework for analyzing the business cycle that we're in. So perhaps let's start with that, and then that could lead us on to how you're looking at the world.
Yeah, I think for most investors in their professional careers, mostly live through credit-driven cycles. And what I mean by that is cycles where the expansion of economic activity and household demand has been meaningfully financed by incremental borrowing. So if you go back to the, say, 2008 sort of cycle going into 2008, what you saw was a boom in borrowing by households, partially to invest in houses, partially to support consumption. And when you had an elevated interest rate, that started to reduce the desire to borrow, which eventually slowed borrowing. And that created the turn in both, the economy and in asset prices. The dynamic today is pretty different in the sense that if you look at what households are doing, you see that they are spending. Their spending growth is rising by about 4 or 5% a year on a nominal basis, and their income's growing about 4 or 5% a year on a nominal basis, which means that they're predominantly increasing their spending by spending through finance by increased income, and borrowing is at actually recession-like lows. So very little borrowing in the economy, particularly for households. And that makes for a very sustainable expansion, because what it means from a household perspective is that they're not building up the sort of liabilities that would typically come with a credit-driven expansion. At some point you've borrowed all the money that you can borrow. There's not much more that you can borrow because of the deterioration of your balance sheet. And so we don't have that sort of liability problem that will eventually get exhausted. So households can keep their spending growth in line with their income growth. It also means, from an interest rate sensitivity perspective, that the economy and particularly households are much less sensitive to shifts in interest rates in this cycle, in part because most of their spending is coming out of income, and also in part because most of their borrowing that happened coming into this cycle, or post-COVID, was done at term rather than floating rate. Whereas if we went back to the 2008 cycle, about 50% of mortgages were floating going into that cycle. And so you basically have a situation that's just a lot more sustainable. You have a much more sustainable economic expansion here today than you've had in previous credit-driven expansions.
Yeah, and we'll come back to that interest rate sensitivity point. But in your eyes, are there certain historical parallels to this type of cycle? I mean, is it the case that the cycles in the 70s and 80s were more income driven, rather than the ones we saw in the 2000s?
Yeah, I think the most relevant cycles that come to my mind are back in the 50s and 60s. There you had, particularly post World War II, a generation that was coming out of, the Depression was familiar to them, and they were very reticent to take on new borrowing in order to finance their spending. And so most of the expansions that occurred in the 50s and the 60s were predominantly income-driven expansions, low credit, low borrowing, mostly income-oriented expansions. And I think in many ways similar to, U.S. households went through a very painful experience in the global financial crisis. And people have been very reticent to lever up as a function of that experience over the last 15 years. And so, that is very similar in that sense. Now, expansions in the 50s and the 60s, pretty much no one trading today has any direct experience other than maybe being little kids in the 50s and the 60s expansions. So that's why I think it's one of these cases where people are always look to their personal experience to develop and apply the heuristics that they've developed over the course of their careers. And those are just not as relevant today as essentially studying previous cases like those cycles.
I think the 50s and the 60s are also interesting because, as you said, it comes after the Second World War. Of course, we had the Depression before that, which was like the global financial crisis today. And then the war, you could say, was a bit like COVID in terms of, the economy was shut down, massive government spending. So you kind of had something similar to kind of a wartime shutdown of the economy reopening. So you had a kind of a COVID effect today. So there are lots of parallels that we have to that period.
Yeah, I think that's a good a parallel to draw, both the depression or deleveraging environment and then the wartime type spending. Of course, during COVID, a lot shorter time. All that was sort of compressed in a lot shorter time frames. But certainly in the core of our personal experience.
Absolutely. Now you did talk about declining interest rate sensitivity, which leads us back to whether the Fed's hiking cycle that we've seen so far has actually tightened policy or not in terms of actually having an impact on the economy. Because one puzzle almost has been that at least the Fed says that they've increased interest rates dramatically in the nominal terms, and so they've had this big effect to bring inflation down and so on. Yet when you look at the economy, stock market, and so on, you would not have really known that the Fed had raised rates. So how do you look at what the Fed's done? Are we restrictive or not, and the impact on the economy of Fed policy?
Yeah, I think if you look at this question of are interest rate hikes or the current level of interest rates, very restrictive or not restrictive? That question that's an empirical question. That's not a theoretical question. I think there's a lot of people who get sort of wrapped up in what is R star and what is neutral and theoretical reasons why it should be one level or another. And I think for people who trade markets, in the day to day, like, who cares what some theoretical R star is? Like, what you care about is, are interest rates high enough to slow the economy or not? And I think when you look at that question, the it's not like interest rates have had no effect on the economy. They certainly have had some effect, particularly for those borrowers who need incremental borrowing to sustain themselves, have faced much painfully higher interest rates. And so the most liquidity sensitive sectors have experienced a significant tightening as a function of that. And so you see, like, the most sensitive liquidity sensitive sectors like venture capital, loss making enterprises like that. A lot of them have failed, are failing, prices have fallen a lot, et cetera. The issue is, at an economy wide level, those sectors are just are not that sensitive, or are not that big a deal relative to the overall economy. Most of the overall economy is cash flow positive, whether you're talking about businesses or households. They're cash flow positive, they're not borrowing a lot of money. And so therefore, it's not that the interest rates have had no effect, they just haven't had that much of an effect, and certainly haven't been able to overwhelm the income growth effect, both for households as well as for corporations, over the course of the last couple of years. And so you're seeing a slower economy than would otherwise occur if those rates hadn't risen, but not one that is, certainly not very restrictive. Like, I think this idea, I almost have to chuckle every time someone talks about very restrictive monetary policy. Like, let me tell you a story about very restrictive monetary policy. Like, very restrictive monetary policy means stocks are going down, credit spreads are going up, the economy is slowing rapidly. Like, where in the world is very restrictive monetary policy? Credit spreads are at lows, stocks are at highs, the economy's grown at 2 to 3% real for the last 8 quarters. Like, what on earth do you look at to say this is very restrictive monetary policy, except theory, some theoretical notion of R star?
Yeah, I mean, some people are pointing to things like weakness in the manufacturing sector. The PMIs are weak. They're pointing to jump in the unemployment rate recently, where it broke. It moved above the so-called SARM rule. People look at the performance of stocks outside of the Magnificent Seven, which has been relatively weak. So because of all of those things, people have started to talk a lot more about, okay, there is something happening here. We are about to hit a recession.
Well, there's a big difference between a late cycle moderation as a function of tighter monetary policy and the idea that monetary policy is very restrictive and we're falling fast into a recession, right? Those two things are they're just very different stories. And I think what's coloring people's view of this sort of dynamic is the credit-driven cycles, because it's true, credit-driven cycles are acute on the downside because they're self-reinforcing on the downside, which is typically a very high borrowing, and then that starts to slow, which deteriorates asset prices and incomes and balance sheets, and that creates further deleveraging and further deleveraging. But that's not what's going on here. What's going on here is a very, very gradual slowing of economic conditions. It's true, yeah. The unemployment rate's up, 70 basis points over the course of the last year, but it was at 3.5%, 3.4%. It's not like we're talking about something that is like a disaster here. We're talking about a very gradual slowing, not to mention the fact the unemployment rate is the weakest, essentially, of all of the labor market indicators. Or let's talk about manufacturing. Capacity utilization is at it's at the 25-year average. So it's moderated a little bit, but we're not talking about, you want to talk about a recession, we're not close to a recession here in terms of the manufacturing sector. And so I think people are trying, it paid for a long time to try and get ahead of the immediate downturn type dynamic, particularly when you were talking about credit-driven cycles. So once there was some moderation, it was self-reinforcing to the downside. And that's created a trained behavior where people think that just because I see some weakness somewhere means that we're going to collapse, the economy is going to collapse. And look, what have we learned over the course of the last 3 years, which is that a weakness in one area or some signs of softening are not good predictors of the path of the overall economy and monetary policy. And I think we're seeing the same thing largely play out again today.
And so, when you think about, trying to predict a recession, I mean, that's probably a mug's game, but what are the types of things you'll be looking at to try to understand whether we are going into a recession, whether even if it's at, in a slow motion recession or however you want to sort of frame it in terms of speed. But, what things are you looking at to give us that signal?
Well, I think when you're looking at the idea, how do you get to recession, is you basically have to have a slowing of spending and investment. And so in an income-driven cycle, that slowing of spending and investment typically has to occur because people are shifting their views on the desire to spend versus save their income. And so what causes households or businesses to shift their expectations or their desires to spend versus save is typically asset prices. And the reason why that is as asset prices are rising, balance sheets look healthier. And so the desire to, the willingness to spend out of your income is higher. If your 401k is at peaks and your house keeps going up, et cetera, and your desire to spend out of your income is lower, if those things are falling because you realize you need to, save more to make up for the fact that your balance sheet is deteriorating. And similarly, businesses often respond to demand, but one of the ways that they see demand or understand demand is through their stock price. And so it's really asset prices that hold the key to this dynamic. The idea that, and when we look at that, asset prices are high. So there's no that's clear. Balance sheets are in the best shape that they've been, frankly, in decades for households and businesses. And as a result, you're seeing investment and, low and declining savings rates from households, which are maintaining that spending. So you'd have to see asset, the linkages are what matters. This isn't like a temporal issue, that it's about the linkages, which is asset price. In order to get a recession, you have to have a fall in asset prices. That's the linkage. The fall in asset prices leads to a desire to save more relative to spending, which leads to a slowdown in spending, which leads to, weaker cons- consumption, which leads to weaker employment, which then is self-reinforcing on the downside. But that's how this has to play, is that the asset prices have to fall first in order to get the recession, not the other way around.
And that begs the question. I mean, what is your view on asset prices? We've had some wobbles over the last few months in equities, at least. We saw serious correction. It bounced back. Over the past few days, there's been some weakness as well. But what's your view on asset prices?
I mean, they're pretty high. Like, what else is there to say? If you look at if you're looking at the U.S. and I predominantly look at indexes or macro asset classes, not really at any particular sector, et cetera. But you look at the big picture, stock earnings growth expectations are in the mid-teens over the course of the next 18 months on an annualized basis. That's very high for a late cycle environment. PEs are basically just off, 2000 level peaks, which is very high in any reasonable context. And, bonds are pricing in a very aggressive cutting cycle, 200 basis points or more over the course of the next 12 months. And so, and term premiums are roughly zero. So you look at that constellation of things, that asset prices are very high. And they're particularly high in the context of 5.5% cash rate, right? So when you think about asset prices, you don't want to just think about, the level of asset prices, but you want to think about them in the context of the alternatives, particularly the risk-free alternative in cash. And so it's pretty hard to see a dynamic where, assets, given the risks involved in holding assets, look all that compelling relative to cash, given the current valuation.
I mean, does that then mean if evaluation suggests equities or asset prices will go down, then that increases the probability of the recession dynamic that you talked about earlier sort of kicking in? There's kind of an interesting transmission then from equity valuations, all the way down to household incomes, and then a recession.
Yeah, I think that if a recession is going to emerge over the course of the next, time frame that anyone cares about, 12, 18 months, it's probably going to be, let's call it a disappointment recession, disappointment driven recession. And the reason why that is as you say, asset prices are very elevated, very high expectations in terms of growth conditions, very high expectations in terms of easing. If you disappoint on either of those elements, you'll probably see asset prices decline from here, and that could start to kick off this dynamic, this cycle, a downward dynamic. But you've got a long way. You got a long way before you get to a significant amount of business, of demand weakness and business weakness and layoffs and the sorts of things that exist in a recessionary environment. I think it's probably one of the things that is very challenging when you look at something like the bond market, where I think there's a lot of folks who are kind of front running the recession. Like if you buy bonds, there is no recession today. And you don't want to buy bonds before you've had the fall in asset prices that are necessary to then get the recession, right? It's or similarly in stocks, people are like, well, the Fed's going to ease a lot because growth is slowing and inflation is moderating, but that's not going to happen unless asset prices first fall and then you get the monetary response. And so I think people are trying in a lot of ways to over front run the macroeconomic linkages, and the result is that they're just paying sky high prices for these assets before the types of adjustments that have to happen in order to get the outcomes that are being expected actually occur.
Yeah, it seems like the scars of the global financial crisis are still with people, and so people are always trying to forecast the next crisis, which hasn't really paid off in the last few years, at least. We haven't talked about inflation yet, and there seems to be a sort of growing consensus, whether it's the markets pricing, analysts, or the Fed themselves, that in general inflation is no longer a problem. Are you in the same camp or not?
I think I'd say not so fast on that front. And the reason why that is that we have two meaningful tests coming up on whether inflation has durably fallen to 2%. First of all, let's make sure we remind ourselves of the starting point. Inflation is not at 2%. 2% is the Fed's target. PCE is still above 2%. A lot of different ways you can slice it, but between 2.5% and 3%. CPI is above that. Core CPI is above that, and so we're not at the Fed's target in terms of inflation. So that's our starting point. Remember that. Just to get to this point, it has taken remarkable goods disinflation over the course of the last 12 to 18 months. Now, part of that has been a resolution of the supply chain issues that caused a big inflation spike. But at this point, when you look at things like core goods prices, they're disinflating or deflating at a level that was equivalent to or even more negative than pre-COVID levels. Now, do we think that we're in a world where you'd expect an extended period of core goods price deflation? I don't think so. And just the movement of that core goods price inflation back to something at pre-COVID levels, or let's say above pre-COVID levels, given, the global deglobalization dynamics and tariff risks and, various shipping issues. There's a lot of reasons why you might think that core goods would end up, prices would end up rising faster than they were pre-COVID. Services inflation is still very elevated relative to pre-COVID. So unless you have to have an extended period of very weak core goods prices to offset the elevated services price inflation in order to get to that 2% level. And the real question is that really going to happen? Or have we gone through a period basically where we're at a price spike related to the supply chain issues, a price normalization related to the supply chain resolution issues, and now we're going to go back to inflating in those prices. So we haven't tested that and we haven't resolved it. And if you think like any person who's like, well, inflation's 2%, what they're saying is we will have relatively extreme core goods inflation forever. And I don't think that that's a reasonable expectation. So that's point number one. Point number two is, let's say we actually get these cuts. We're going to get probably some number of cuts. The question is, do we get a reacceleration of the economy as a function of those cuts? We're already starting to see, mortgage applications for refinancing start to accelerate. Do we start to pick up more activity as a function of that easing? That would be a particularly concerning circumstance because we are not at 2%, right? So having a reacceleration of the economy at a time when inflation has not yet reached the Fed's mandate is another test to see whether inflation is durably back down to 2%. Central banks through time have learned that when you start to cut before you get inflation back to your mandate, that often leads to a second rise in inflation, and that's the risk that the Fed has in front of itself if it continues, if it cuts aggressively at this point.
And so on the Fed, then you mentioned the possibility of cuts. The market is expecting a cut in September, 3 to 4 cuts by the end of this year in total. One of the meetings could have a 50 cut. What's your view on what you think the Fed will end up doing?
Well, I don't. One meeting to another is not. Who knows? One meeting to another. It's not that interesting to me. I think looking out 12 months and seeing 200 basis points of cuts and saying, for what reason? For what reason are we cutting 200 basis points? 200 basis points of cuts is equivalent to the rate of cutting over 12 months is equivalent to the rate of cutting that we saw in the depths of the financial crisis, in the depths of the tech bust, in the worst of the 90 recession. So the sort of reason why central bank would cut with that level of aggressiveness would typically align with very weak economic conditions. And then I turn my attention and look over and say, didn't real GDP just print at 3%? Don't we have timely estimates of GDP in the 2 to 3% range? Unemployment rate has modestly increased, but if you look at a broad set of labor market indicators, certainly nothing looks like a recessionary environment. And so you put that all together, you say, for what reason would we cut 200 basis points over the course of 12 months? And look, like there's always this case for the reason why the Fed is going to cut very, very aggressively. Remember, the start of this year, the Fed was priced to cut 7 times over the course of 24, and that went all the way back to essentially 0. And back then, how many cases were made for why 7 cuts was totally appropriate for the economy at the time, or post SVB, or in late 2022? Like, time after time after time, we have heard this tale of recession is right around the corner. And the short rate market's been dead wrong on. And I think what's happening right now is setting up for a similar circumstance.
Yeah, that's fair. And we haven't talked about the election factor here. So obviously we have a US election coming up. We've had this big turn of events with Kamala Harris replacing Joe Biden. How do you look at like an election as a factor when it comes to investing in markets?
But I think most elections are more risk management type periods rather than times to generate alpha. I think anytime your macro manager is out there saying that they have an edge in trying to predict U.S. elections or UK elections or any of these elections, like they're getting over their skis. The ability to predict the macroeconomy is totally unrelated to the ability to predict elections. Frankly, elections seem, much more in the area of astrology to me than they are of concrete fact. And so when you're trading through these sorts of periods, you want to understand what's priced in, but probably the biggest thing you want to understand is making sure that you're not overly exposed to one particular outcome or another. In this circumstance, I think it's any reasonable person say basically it's a coin flip. It's about a 50-50. Anything other than that is kind of marginal. There are relatively big differences between the parties. There's some similarities in terms of likely continuing an expansive fiscal policy, but there are pretty big differences, whether it's about tariff policy, immigration, or about let's say corporate friendly positioning, whether it's on taxes or regulation. And so, an election of either party could create meaningful divergences in asset markets. And so you just don't want to be overweight one particular view or another. And I think if you went through the 2016 election or you went through Brexit, which are both, I think, good cases where you had bimodal outcomes that were very, very close, and you had large market moves in either direction as a function of those outcomes, and some of which were unexpected. I think it's very important just to not get too overweight one particular outcome or another.
Okay. Now, we've talked a lot about the US. I know also you do look at other locations and geographies as well. You've recently looked a bit at Japan and the BOJ. What are your thoughts there?
I think a lot of folks are looking at BOJ rhetoric and thinking and like translating that into something, I say through a Western lens. And the Japanese policymakers have long sort of hoped for some normalization of monetary policy. If you've been doing this long enough, you remember, past hikes, past very de minimis hikes. And for whatever reason, in that context, they see, for instance, shifting from a negative interest rate to a very marginally positive interest rate being a meaningful story. I don't quite understand why that is viewed as being something significant, or moving from 10 basis points to 25 basis points is an element of focus for or meaning for Japanese policymakers. But when they're speaking about tightening, they're talking about that magnitude of tightening. de minimis, tweaky, irrelevant tightenings, not meaningful. So as a simple example, if you look at what's priced into the 2-year interest rate market in Japan, it's at 30 basis points or something like that, 35 basis points. The current target rate's is 25 basis points. Okay, so what does that mean in terms of what the markets are pricing in terms of Japan over the course of the next 2 years is nothing, right? So we can go to the parliament and we can talk about how there's a normalization of rates and all this stuff, and the markets could be right, they could be wrong, but I think that gives you an order of magnitude sense. It's the market are like, you're going to on average have 13 basis points higher monetary policy over the course of the next 2 years. Like, why are we even talking about Japanese policy, like monetary policy here, if we're talking about 13 basis points? Who cares? Like, the volatility in the yen on a daily basis is 1%. So this is a totally irrelevant to the total return that you're going to experience on the yen, or totally irrelevant to what's going to drive the yen supply and demand. It's a totally irrelevant type scenario. And so that, I think, is coupled with the fact that if you look at the underlying macroeconomic reality, core inflation's at 1%, wage growth is about 1.5%. It's kind of stuck there in terms of where we've been. That is a bit better than it was pre-COVID, but we're certainly not in a world where Japan is in need of meaningfully tighter monetary policy. And I should emphasize that the fact that what inflation Japan has had has primarily been a function of the FX translation effect of a weak yen on domestic prices. And so the fact that the yen has rallied has essentially created all the tightening that's necessary for the economy and to bring down inflation, ahead. And so it's not clear from a macroeconomic standpoint. There's no real reason to do much at all. From a market pricing standpoint, while the rhetoric seems very significant, it's, from an economic perspective, it's just irrelevant. It is just irrelevant, and
A lot
so
of
it gets
ink
more
has been
attention than it
spilled
deserves.
talking about BOJ policy, and so it's good to kind of get your perspective there on what we're really talking about here. How about Europe?
How about Europe? Well, I think Europe has an unemployment rate that is at its lowest in many decades, and I think that's an important sort of starting point when you're thinking about the European economy. So many folks will go, well, Europe's growing slowly, and Germany is, German manufacturing is getting eaten alive by Chinese production and all this stuff. You'll find lots of reasons why you should be negative on Europe, but at a fundamental level, the European economy is doing reasonably well relative to its capacity, and the unemployment rate is a good indication of that. And part of what's going on there is that the tight labor markets are continuing to lead to relatively elevated nominal wage inflation, particularly relative to very low productivity growth in the economy, and that's continuing to keep service inflation elevated relative to the ECB's longer term goals. And that's creating an environment where not only are economic conditions, they're not strong, but they're strong enough to not create an urgency to ease, but they're also continuing to create inflationary pressures in the economy. And so when you look at what's priced into that market, which is particularly in the short rates, which is relatively aggressive cuts, not as aggressive as in the US, but relatively aggressive cuts in the context of elevated services inflation, elevated wage inflation, et cetera. It seems unlikely that we're going to get quite the aggressive easing in Europe as well that is currently priced in.
Okay. And so if we kind of round everything up together, I mean, from a portfolio perspective, I mean, how are you positioning your portfolio right now, given everything that we've talked about?
Well, I think when you're looking, if we connect it to asset prices, which is, and what that's what we have to do whenever you're investing, it's so important to start with what's priced in. It's like very easy to get lost in all the trends and things like that, but you got to start with what's priced in. And particularly when you look at US assets, what's priced in is, on stocks is essentially very aggressive positive growth environment, and on bonds, very aggressive easing environment. Neither of those seem as likely as currently priced in. And so, cash relative to assets looks attractive at this point. And more globally, when you look, across different economies, particularly if you start to look at Europe or the UK, um, or let's say Australia, the significant easing cycle that's currently priced in to many of those economies seems inconsistent with the macroeconomic pressures that are going on. And their equity markets are typically, if you scan across all those, particularly if you look at sort of domestically oriented equities in either the UK or in Europe, those are less extreme in terms of their pricing than US stocks. And so being bearish on those assets seems, less compelling. But particularly in the short rate markets and things like twos, it really does not look all that compelling to be, long bonds or long twos in this market.
Okay, that's great. Now, I did want to sort of round off with just a personal question, which is I do like to ask my guests something about their sort of cultural recommendations. Any good sort of books, TV shows, films that you've been watching or reading recently?
Well, I'm a podcast junkie, and not just macro podcasts. So there's lots of excellent macro podcasts out there. But I do like to enjoy other podcasts. So I've been catching up on Radiolab, which if you're a science nerd, I highly recommend, including a very recent one about the nature of memory, which I found fascinating. Um, the gist of which was that by the sheer remembrance of a circumstance, you alter the chemical composition of the memory and actually adjust it. And so your best memory, your most accurate memory, are those that you have not spent time remembering. Sort of in contrast to what might be your intuition, right? You might think that which you remember more often is likely more accurate, but the reality is exactly the opposite. So anyway,
Oh,
take
how
that
interesting.
as a
Okay, that's
little
great.
intrigue. It's a very good Radiolab from WNYC. You could definitely, I mean, it's on Spotify and all those
Yeah,
other
that's
places.
great.
And it is a top podcast in terms of ratio of minutes listened to interesting things that enrich your life.
Right. No, that's great. Now, finally, what's the best way for people to follow you or reach out to you?
Yeah. So if you like or don't like whatever macro takes I've given you here, you can either enjoy or argue with me on Twitter. I'm at Bobby Unlimited, very active there. I have a YouTube channel if you like sort of more clips of various media that I do, at Bobby Unlimited, where we also have a monthly webinar, sort of a macro outlook webinar there as well. And if you're interested in the finance industry, I write on a regular basis on LinkedIn related to the finance industry under my name. So at Bobby Unlimited or under my name, you can find me. I'm around.
No, that's great. I'll make sure to include those the links to those in my show notes. So with that, thanks a lot for the really insightful comments that you had during our conversation, and good luck with everything that you're working on.
Thank you so much. Thanks for having me.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.